exactly. But here you'll notice that there's no policy drag. There's no premiums, there's no taxes, and there's no management fees.
Hmm.
Questions?
Sign me up.
Sign
Nope.
me up.
It's
Uh-huh.
just because I've heard this like 3 times, guys. So I don't know where you are, but like I learned by immersion. So I listened to Eric the first time when I was driving, and then he and I talked. And then this time I got to see the slides. I think this is probably, if you're interested in help, this is me, and I'll turn my camera on so you can see me. I know that the guys say you gotta have your camera on all the time. So let me turn my camera on. All right. If you, I mean, I just think if you're really interested in not only helping your current customers, your past customers, and your future customers, like I'm going to incorporate this into my business
Yeah.
starting today, like not just for investors, but for regular everyday Americans. Because I have been knocking around the investment financial management world for decades. This actually makes the most sense and is the most empowering approach to managing money that I think I've ever heard. That's just me.
It,
Sign
it,
me up.
it was for me too, William. Like I said, when I first heard this, I went, oh my gosh. And then I went to I said, hey, can I do this? And the guy goes, well, do you have a life insurance license? And I said, yeah. But I had it because I was working at AAA selling P&C. So I was selling property and casualty, but I had my life license, right? I wasn't using it, but I had it. And the guy said, well, if you want to learn how to do this, you can come to some training. So I flew out to Florida that like 2 weeks later after first introduced to this thing. And that's when I was sitting in there, we were already in the process of getting me a policy at 700 and whatever I said it was, 740 or 760. I honestly don't remember, but I remember going into the cafeteria at lunch that day and saying to the guy, "Hey, I want to put in 9,000 a month." And he said, "Slow down, cowboy." But that's the thing. I understood the math. Hmm.
Hey, Eric, could you go back to the slide where you're paying down the debts? Um,
Yeah. In fact,
Thank you.
uh huh. How this works. In fact, here, I'll just show you live with that thing. Thank you for. So
Oh, yeah, that would
inside
be
this tool I've got, yeah, I'll pay you later, Christina. Thank you. You sound like a paid commercial here for me because I keep asking all the great questions. So here's that same couple, Matthew and Mariah. So what I end up with is a comparison chart, and I usually walk through your clients with on this. Okay, so here's their current balance, and here's the debt action plan. So if I start moving this debt action plan out, you see that they're in month 2, they're going to pay off their first credit card. And then month 3, they pay off the next one. Month 4, the next one. Month 5, the next one. Then we keep going and they don't pay off another one. So at the end of the first year, they pay off their car. Now, notice over here, they just paid off their car. They have 28,000 in their cash value account and they just borrowed 27,800 or 27,089. They owe that money back to the insurance company. But as we just saw, what's the cost of their capital?
1,600?
No, let's go back. Let me show you again on the spreadsheet so that's clearer. Here, let's walk in here and do this. And I walk through this usually with people. Okay, so I've got it up here, $30,000. And here's the reality. That client, that couple, they are currently earning 5.2% and they can borrow at 5. So if we look at that, the first year getting paid at 5 instead of what I was saying earlier of 4, they're going to earn 38,866. Everybody with me there? In 5 years. Christina, it was your question. So does that make sense there, obviously?
Eric, it's actually Maricel's question. It's a great one.
Oh, Maricel's? Okay.
Yes.
Yeah.
Okay, sorry,
Okay, so
Maricel.
if I could just dumb it down. So the couple put $50,000 in to the life
Okay.
insurance,
Uh-huh.
right?
Yep.
And they're gonna borrow 30,000 to buy that car.
Mm-hmm.
So what you're showing here is the 5-year plan, how they paid back the 30,000.
Yes. So
Okay.
give me an interest rate. Here it says traditional market loan. What's it going to cost to go borrow to get a car right now?
Probably, yeah, 7.
7.5. Okay. And let's say it's a traditional car loan. It's over 5 years and it's starting in year one. So
Okay.
there, and on all, and yes, you made a good point. If they've got 50,000 in their cash value account, then their whole 5,000, their whole 50,000 is growing at 5.2. But to be honest, I'm only going to show 30,000 to 30,000 because that's the amount we're fictitiously saying they're borrowing for a car. You okay with that?
Yeah.
Okay. So that 30,000 that they didn't have to pull out of their bank account and spend in cash has grown from 30,000 to 38,886. And they've continued to pay back to the insurance company as if this was a structured loan, just like it would have been if they had gone to a bank and gotten that car from Toyota Finance, right? Did they have to make those payments that way?
No.
No. And that's what's so important about this. I, I had 16 rental properties when I decided to get out of the Marine Corps, and that was my retirement. And then 2008 hit, my wife and I lost every one of those. I had been working as a vice president of research and development at one of the Baby Bells. I was a telecommunications officer in the Marine Corps, and that's what I got hired out at. I've got a master's in telecommunications. So that's where I had been, is in the worlds of telecommunications. And as you guys all know, the .com just trashed my industry. Okay. All of a sudden, I found myself on the streets. I was working for AT&T. They laid off 20% of the workforce, and all of us were out there looking for the same job. I had all these houses that I had put on 15-year notes, and so not all of them were cash flowing positive. That was one of my biggest mistakes when I bought my rental properties, is that they weren't all cash flow positive, and we ended up dominoing and losing all of our properties. But the point was, and all of us as loan officers understand that, was it that I wasn't employable anymore when I lost my job from AT&T? No.
No.
I had
Conditions
2
change.
master's degrees and I had been a vice president for 10 years, you know. But finding another vice president job, making the kind of money I was making, just didn't grow on trees when 20% of us got laid off, right? So it took me 9 months to find it. How many of my banks were willing to cut me some slack for 9 months?
No.
None of them. And we
Banks
lost
don't banks don't do
everything.
slack.
Exactly. And if I had had money sitting in a cash value account, I could have taken my rents and that little extra that I didn't have and kept everything afloat until I got that next job. But I didn't. Anyhow, I've diverged from what I was talking about. But the point is, this is a non-structured loan. And so if I had gotten laid off in year 2, I don't have to make that payment unless I want to.
Oh, that's nice.
That's my point there, because we all know that when you need money the most is when banks won't give it to you.
Yeah, absolutely.
Okay, so all of us are loan officers and understand those concepts. But assuming that you were making regular payments as though it was normal, you're going to pay that loan off in 5 years, and this is how much interest you would have paid. Okay, now at the market rate of 7.5, that payment for that car at 30,000 would cost you $618 a month, or $7,415 a year. Everybody with me there?
Mm-hmm.
But because this couple is able to borrow for free, because it's really not, they're getting paid 20 basis points. Really, all they have to do is make the principal payment back every month for the 5 years at $500 a month. So the difference between the regular payment and what they have to pay back that loan is another $1,400. So what I usually tell people to do, and this gets to the question you just asked, well, get back to the part where they're actually paying it. I say to them, look, if you could have afforded to go borrow that money and paid $618 a month, pay the $618 a month, or $1,450 back into your policy every year as though you were your own bank. So who's making the interest now?
Yourself.
You are.
Yes. Bingo.
So, okay, I have a
That's
dumb
why this
question.
is called private equity banking, because we become our own banker. We become
Okay.
that guy behind your head, Maricel.
I got it.
That guy back behind you, who's really
Oh.
Mr. Morgan.
No.
Yeah. You know, we become our own banker. We put that money back into our pockets. So now we have the part that our money grows at, which is the actual illustration increase, but we also have this extra money that we're putting into our pockets. So really, we're earning about an extra $3,000 a year for loaning out that $30,000, and we're putting back into our own account an extra $15,961 on this $30,000 loan.
So if banks are FDIC insured up to 250, what about this private equity whole life?
Nothing. And that's why it becomes so important. And that's why I spend all my time explaining the difference between an insurance company and a bank. These guys are super, super solvent. These companies have not only made money every year, they've paid dividends every single year, most of them that I work with, for over 120 years each, in between 120 and 150 years, to include the Great Depression and all of the recessions. So when you get a policy loan from them, part of it's guaranteed and part of it comes as a dividend. But again, that dividend is paid out to whom?
The co-owners.
The co-owners. Thank you, Will. To you and I, the owners of the policies. So the fiduciary responsibility of those executives is to make all of us money, and they're very conservative in doing that.
So Eric, I have a dumb question.
Sure, go ahead.
So you said that your cash value is what? Like, what did you say, 189 or something like that?
Yeah, it's almost 200.
grand.
Yeah.
What caps you from how much you can borrow? Is it the
That
cash
amount.
value?
Yep, my cash value is the amount that I can borrow.
Okay.
So you do have to build that. So, with mine, if we go back to the PowerPoint presentation, and I showed you guys that young man that's 26 or something like that. Where's that PowerPoint presentation at? This young man, his policy looks more like a policy for a young man that's 26 years old, right? I mean, he's only putting in $520 a month. But I will tell you the story about this young man. So we started this with him, and he said, well, I want to be able to save enough money to buy my own car, my first car. Now, he didn't tell me he wanted it in 5 years, but he knew that he had a car in mind. It was about $30,000 what he wanted to spend. And he told me that he wanted to throw about $150 a month into this thing, right? So I built him an illustration around putting it at $150 a month. And as he looked at it, he was like, well, that's not growing fast enough. Well, could I put in $500 a month, Eric? And I said, let me talk to the insurance company. So I talked to the insurance company. I said, can this young man put in $500? Because there's still limits. Remember, this is tax-free. And the reason it's tax-free is because, according to the IRS, it has to waddle and quack like an insurance policy and not a savings account. The minute it begins to waddle and quack like a savings account, the IRS says, no, this is taxable. And that's why death benefit comes into play. The one word I haven't used the entire conversation, but that's where death benefit comes into play, is the IRS has to say this is tied to an amount of death benefit commensurate with the premiums being paid. Otherwise, we consider this a savings account. But that's where I do some magic to mix both whole life and term life. So you get a lot of inexpensive insurance. At the same time, you're getting the more expensive stuff, but that allows you to shove more cash into this thing. Anyhow, I digress. But this young man, after he looked at it at 500, he said, well, you know what, Eric, I've got an extra 5,000 sitting around in my bank account right now. Could I put it in? And what's the max the insurance company will let me do? And the max they would do is 520. I find that over and over again, when people begin to see the magic of this, they will want to max it out on what they can at their current status in life. So this young man is maxing out at 520 a month, whereas Eric, when I got mine, I was able to put in 5,000 a month and nobody blinked an eye because of my income at the time. But due to his income and his age, he was only able to put in 520 a month. Does that answer that question, Christina?
Yeah, it does. Yeah. I mean, and I'm just thinking, how can you screw it up by not making your premiums or something? Does that fall apart when you stop making payments, or?
It does to an extent, but again, it's got that special part. If I bring this back on here and we go to RPU. So what ends up happening, let's say that, this person, and this has happened, by the way, here at NEXA. In fact, I just got a video testimonial from a gentleman here at NEXA who got one of these 3 years ago with me, and we all know what's happened to loan officers over the last 2 years. We haven't made the same amount as we were 3 years ago. And so he actually lapsed on the policy and wasn't able to make the payments. It was only about 5 or 6 months lapsed. He called them back and said, "Hey, can I kick this back off again?" And they said yes. So within the first year, you can do that, but there's also some backdrop here. So this young man here, back to his, he has 8,224 this year because he threw in 5,000. By the way, the part that goes into savings is all savings. It's not buying insurance. And so he has 8,224. If next month he got laid off from his job because he's a W-2 employee and he didn't have the 520 bucks, what they'll do is they'll just pull it out of that 8,224. So if we did the simple math on that, not that that would happen, but that would be a worst case scenario. Let me pull down a spread my calculator because everybody will be able to see this. So he has 8,224 in there, and if we take out, and by the way, his real payment is not 520, it's only about 250. A lot of that's going into savings. So let's just say dividing that by 250, which is the insurance portion, he has 32.8 months worth of payments that could just come out of his already existent cash value. So, divide that by 12, and you basically got 3 years worth of payments sitting there in his cash value right now that would keep the policy alive if push came to shove. So, any other questions? Those are great questions. You guys have been fabulous today. Jim.
Yeah, I have a
Hey,
couple.
Eric.
Jim had a question first. Just a second, Marisol.
The 5% rate, is that fixed for life or does that change?
It is not fixed for life. It can change, but it changes extremely slowly. So this 5.2 that this company is at is where they've been at for 2 years. Most of these companies have been at something between 4.5 and 6.5 for the last 40 or 50 years.
Oh, okay.
Mm-hmm.
So if interest rates went up and up and up, and down the road, bank CDs were 7, 8, 9%, would this go up also?
It would, and the reason is because they can then lend money at a higher rate. So I'll tell you where these folks invest their money. So what's happening there, Jim, these folks invest in super conservative stuff. So in the city I used to live in, they put out a bond initiative to run fiber optics to the curb of everyone's home. And the city needed money up front to dig up the streets, throw in the PVC, and then blow fiber optics through it and connect everybody's homes in the whole city. And so they went to an insurance company to get that loan. So the loan was not only secured with a bond that the city put up to pay that loan back, but also the taxpayers buying this fiber optics and taking a portion of those profits and paying back the city, who is then paying down the loan. That's the kind of stuff these guys invest in. They don't invest in risky stuff like in stock market stuff. That's why when you ask, can it move? Yes, it can, but it moves at a rate that's super, super conservative. And again, if they make more money this year, then next year they'll pay out more because it's a mutually owned company by us.
Got it. Another question. I wanted to clarify my understanding on, if you've got a borrower and they've got 50 grand and 10 different credit cards, wouldn't it make sense to just put all of your available cash towards paying just directly to the credit cards to pay those down as soon as possible instead of putting it into the life insurance policy? Because then you have less money to pay down the credit cards. I'm confused how it pays off the credit cards faster by taking some of your cash flow and putting it into the insurance.
Okay. And the simple answer is this. What's a credit card usually cost? What's the percentage?
20%.
Exactly. And if I can trade a 20% loan for one that I'm getting paid 20 basis points on,
yeah,
that's the reason, because my money is not costing me as much to do that.
I mean, what I mean is if I have a bunch of credit card debt, don't I want to pay all that off as soon as possible just with my cash flow?
Absolutely. But you want to run it through this first, because then it's growing at 5.2% for the rest of your stinking life. So you put in
Oh,
what
I
you
see.
can and
Oh,
then
I see.
borrow
I
back.
see what you mean. Oh, so I could either just pay 5 grand to one credit card, or I could take 5 grand, put it in the life insurance, and then I could take the same, a different 5 grand from the insurance, and then pay the credit card. But
Exactly.
now I've got the 0.2 spread or whatever on my money, which doesn't sound like a lot, but it's just the principle, and it adds
Well,
up over time. It's
but
the
it's
habit that you
real.
build,
That's a real spread because
right?
it's not just the 0.2 that you're making, but it's also the 18 that you're no longer paying on that credit
Well, as
card.
long as I still have a credit card balance, I still have Oh, you're saying, well, that'd be if I had the cash to pay off all my credit cards. I'm talking about a guy who doesn't have the cash. He's paycheck to paycheck.
Right.
He's
So,
barely scraping by.
which is what that couple is that I was just showing you. So let's go back in there and
Yeah.
look at that couple. Let me go find that spreadsheet. Where was I at here? Here, let's go. Let me share my screen again, and you'll look at how
Uh-huh.
this couple's doing it. In fact, I've got a video if you guys want to watch it.
The first step to setting up your debt action plan is to meet with one of our specialists. They are experts in this exact strategy. During the meeting, together, you will identify how to fund your bank. The main source typically used to fund your bank is any money you pay above the required minimum payments for your debts, low-yielding savings accounts, or money you are saving in government-sponsored plans that are inefficient tax structures. The first strategy you will implement is to only pay the required minimum to your creditors and redirect those inefficient dollars into your bank where your money can work harder and more efficiently for you. Let's take a look at an example of how the system works using real numbers. Meet Tom. He has $70,000 in consumer debt and a mortgage of $300,000. Now meet Frank. He has the exact same debt, $70,000 in consumer debt and a $300,000 mortgage. They both are paying the exact same amount to their debts and are scheduled to have all their debts paid off, including the mortgage, in about 24 years. But Tom is going to implement the debt action plan strategy to pay off his debts faster and build wealth at the same time. After meeting with his specialist, Tom disclosed he was making about $1,200 per month of inefficient overpayments to his debts that could be redirected to improve his overall financial situation. By only paying the minimum payments on his debts, Tom frees up $1,200 per month, which he redirects into his own banking strategy, which is his life insurance policy, making that money work harder for him. After paying minimum debt payments for 7 months and building up the cash value, the debt action plan will now tell Tom to take out his first loan from his policy. That amount will be equal to the first debt he pays off. In this case, about $5,500. The loaned amount is sent to the credit card, paying it off in full and canceling out the interest he was scheduled to pay to Visa. Now, Tom has a new loan from his policy to pay off, but at a much lower interest rate. The $185 he was paying each month to his Visa bill will now go to the loan he just took out. The best part about this strategy is that the loan doesn't affect Tom's cash value's earning potential at all. His cash value keeps on earning a guaranteed interest rate, while Tom borrows money from the insurance policy to pay off his debts. That principle is where this strategy turbocharges Tom's debt payoff. After a few months, Tom is able to take out another loan from his policy to pay off the next debt. He implemented the same strategy of taking the minimum payment for that debt and adding it to the minimum payment of the first debt and sending that amount to his policy each month to pay down the loan. He continues to pay the $1,200 to increase the cash value each month and sends in the extra $625 to pay down the loan. He keeps implementing this strategy until all the debts are paid off. In this case, it took Tom just under 3 years to get his consumer debt paid down and another 6 years to pay off the mortgage. So, a total of 8 years and 7 months, and Tom is now debt-free.
So their total debt a month, whatever that is coming out to, they continue to keep paying, Jim. So even though they've paid off credit card number one, so whatever that whatever they were paying on that, which looks like it was $74 here, they now start paying back the insurance company that same $74 until they've paid that credit card off.
Gotcha. Okay.
And you're never getting rid of this, your capital.
Got it.
Eric, every time you withdraw money, do you pay like a fee
No.
to withdraw money?
Nope. There's no application fee, nothing. All you do is send in a form and say, I would like you to deposit money into the same account that you usually pull my monies out of, and they deposit it in about 2 to 3 days. Once it's started. The first time you pull money, it's probably going to take them about 10 days because they've got extra checks and balances to double check that we're not laundering money. But so the first time it's going to take probably 2 weeks to get your money back from them. After that, it's about a 2 to 3 day process. And no, there's no finance fee, there's no application fee, there's nothing like that.
So the fun part, are we gonna, or how do we sell this to our clients? Do we just book you on an appointment?
Yep. Just reach out and say, hey, I'd like to meet with one of my clients, and we'll go from there. Yeah. Y Maricel, si hablas español, yo también.
Qué
No.
bueno.
No. Okay.
I wish.
I wish. Okay. Well, if you've got clients that speak Spanish, I can also do Spanish with anybody's clients. Mm-hmm.
So Eric,
Yes, Christina.
I think to William Brown's point, this is my second time watching you do this. Actually, when I first came to you, it was a couple of years ago. I think I was very new to NEXA.
Yep, I remember.
And in a completely different situation than I am now.
Mm-hmm.
And I get to skip the debt part and go on to creating part, which to me is, and I could never wrap my head around some of these. It is a total different shift in paradigm, and you have to really understand all of these things. And this has been so great. I mean, I'm going to be making an appointment with you because now I'm ready to go, and I want to understand other things and ask a lot more questions. So I'll save it for when we get together. But thank you.
That was, and by the way, Christina, I saw your name pop in. I was like, yep, I know we've chatted. Yeah, somebody else jumped in about 6 months ago, who I had met with, him and his wife, and luckily you're not in that situation. It doesn't sound like, but they chose not to move forward either. And then he jumped back in and he said, get a hold of me. And I got a hold of him the next day. And as it turned out, his wife had gotten cancer and died in 2 months between January and February. And he jumped back into my thing in March. Boy, did I feel horrible.
Oh, man.
She was an executive at, well, I won't say where, but because you'll run into him. He's a Nexan. But yeah, it was just sad day for me that I hadn't done a good enough job explaining it. And that's why I've built this spreadsheet too, Christina, is because people just weren't getting it. That one I just showed you with Will and his wife, Marissa, the guy that I said does investing that I showed you. And I'll do a video of it because I recorded it the other day. This guy has a master's in finance from Harvard. Okay. And I showed it to him. And at the end of it, he was just like, oh my gosh, Eric, this is phenomenal. And I said, Will, I know what I'm about to say isn't what wins friends and influences people, but you've known about this for 5 years, buddy. Yeah. But you never explained it so well like you did now. So shame on me. That's why I keep trying to make the tools better to help people understand this very complex at times.
And yes and no. Mine was fear-based at that point too. I didn't really know how it all worked, and I was just bright-eyed to even mortgages, the whole yards. But I knew there was something there. Yeah. So now it's just a different position, and I'm excited about it now. Yeah. So I've been trying to come for a while. So I'm glad I was able to come in today.
I'm glad you jumped back in. Thank you. And I look forward to chatting with you again too. I'll just grab what we did before, and I'll throw it into a spreadsheet, and we'll show you that, and then we'll go from there. How's that?
Yeah, sounds good.
Okay. I'll have to go find that one. Any other questions, folks? Send me an email at NEXA, and I will send you out that little video that I wasn't able to get to work, and I'll also send you a free book about this stuff and the audio that goes with that free book so you can listen to it and get it drowned back in from somebody that's even better than I.
That would be great. Thank you. I sent you a couple emails.
Okay. Thank you.
Right.
Any other questions? Nope. Jim, thank you. Maricel, thank you. Christina, thank you for everybody. Will, thank you for coming again. DeMarcus, thank you. I really appreciated everybody's interaction today. It made this so much easier. It's so much fun.
You got it. Thank you, Eric. I'll see you soon.
Look forward to seeing you guys. Bye-bye.
Thanks, Eric.
Yep.
Bye-bye.